Imagine waking up tomorrow and seeing global oil prices suddenly surge to $150 per barrel. Gas prices spike, stock markets react instantly. Airlines, shipping companies, and entire industries face massive cost increases. But here's the bigger question. Could such a price shock trigger a global economic slowdown? And could geopolitical tensions involving countries like Iran, Saudi Arabia, and major economies like the United States and China push oil to that level? Tonight we explore the economics, the geopolitics, and the potential global consequences if oil were to reach $150 a barrel. Before we dive into today's topic, let's quickly connect it with our previous discussion. In the last video, we examined rising geopolitical tensions and how regional conflicts could influence global markets. We talked about how events in energy-producing regions can ripple through the world economy. Now today we're asking a crucial follow-up question. What happens if those tensions push oil prices dramatically higher? Because energy prices affect almost every part of the global economy. Despite the growth of renewable energy, oil remains one of the most important resources in the modern world. It fuels transportation, supports global trade, and powers key industries. From cargo ships to airplanes to manufacturing plants, oil plays a central role in keeping the global economy moving. Because of this, even moderate changes in oil prices can have significant economic effects. When prices rise sharply, businesses face higher operating costs. Consumers often experience rising fuel prices and increased costs for goods and services. That's why economists closely monitor oil markets as an indicator of potential economic stress. The first question analysts ask is simple but important. Is $150 oil realistic? Historically, oil prices have experienced dramatic swings during periods of geopolitical tension or supply disruptions. Global supply chains, production levels, and market expectations all influence prices. When markets believe supply might be reduced, even temporarily, prices can rise quickly. However, several factors also act as stabilizers. Major producers often adjust production levels to manage supply, and strategic petroleum reserves can be used during emergencies. So while a sudden spike is possible, markets also have mechanisms designed to reduce extreme volatility. If oil were to reach $150 per barrel, financial markets would likely react quickly. Energy companies might benefit from higher prices, but many other industries could face rising costs. Airlines, logistics companies, and manufacturing sectors rely heavily on fuel. Higher operating costs can reduce profits and sometimes lead to higher prices for consumers. Stock markets often reflect these concerns. Investors might move money toward energy sectors while becoming cautious about industries sensitive to fuel costs. Another major concern would be inflation. Energy costs influence the price of transportation, food production, and manufacturing. When oil prices rise sharply, those costs can spread throughout the economy. Economists sometimes refer to this as cost-push inflation. Central banks, including the Federal Reserve, monitor these developments closely because rising inflation can influence interest rate decisions. Higher interest rates, in turn, can slow economic growth. This interconnected system shows how a single commodity can influence global economic conditions. Oil markets are shaped not only by supply and demand, but also by geopolitical developments. Energy-producing regions often sit in areas where political tensions occasionally arise. Because of this, global markets sometimes react quickly to geopolitical news. Countries that produce large amounts of oil or control important shipping routes play major roles in global supply dynamics. Even the possibility of disruptions can influence investor expectations and price movements. Many economists believe the global economy today is more resilient than it was during past energy crises. Energy efficiency has improved, and many countries have diversified their energy sources. Renewable energy technologies continue to expand as well. However, sudden price spikes can still create short-term challenges. Consumers may reduce spending in other areas if fuel prices rise significantly. Businesses may delay investments or adjust production strategies. These adjustments can slow economic momentum. If oil prices surged dramatically, governments and policymakers would likely respond quickly. Possible responses could include releasing strategic petroleum reserves, encouraging increased production, adjusting economic policies to support industries and consumers. International coordination often plays a role in stabilizing energy markets during periods of volatility. Such cooperation can help reduce uncertainty and prevent long-term disruptions. Looking ahead, several factors could influence future oil prices. Geopolitical developments, production decisions by major energy producers, global economic growth trends, technological shifts in energy systems. Markets constantly evaluate these variables when determining prices. This is why energy markets remain one of the most closely watched indicators in the global economy. Oil has shaped global politics and economics for more than a century. Even today, fluctuations in energy markets can influence everything from inflation to international diplomacy. The question of whether oil could reach $150 per barrel highlights how interconnected the global economy truly is. Understanding these dynamics helps us see beyond headlines and examine the deeper forces driving global markets. Now, I want to hear from you. If oil prices reached $150 per barrel, which part of the economy do you think would feel the impact the most? Energy markets, stock markets, or everyday consumer prices? Share your thoughts in the comments below. And if you enjoy clear and in-depth analysis of global economics and geopolitics, make sure to subscribe and stay tuned for the next update.